Today's economic system did not emerge naturally. It was constructed through policy decisions. After 2008, central banks faced systemic collapse. Markets had frozen, trust within the financial chain had fractured. To prevent total failure, interest rates were pushed near zero. Then an unprecedented step followed. Large-scale liquidity was created. This was not a temporary stimulus. It became the foundation of a new financial era. Low rates evolved into the system's core operating principle. Near-zero interest rates altered incentives. Saving became less attractive. Credit became easily accessible. The cost of risk dropped dramatically. When money is almost free, debt naturally expands. Corporations refinanced. Consumers increased leverage. Governments expanded spending. Economic growth was no longer driven solely by productivity. It became dependent on monetary expansion, and liquidity was abundant. Asset purchases accelerated the transformation. Central banks acquired government bonds and financial assets at massive scale. Yields were suppressed, capital was injected into markets, asset prices gained upward momentum, equities, real estate, corporate debt. Capital did not disappear. It shifted toward risk. Low interest rates rewarded expansion. Corporations borrowed to repurchase their own shares. Valuations climbed beyond historical averages. Profits lagged behind growth narratives. Investors searched for yield everywhere. When safe returns vanished, speculation replaced discipline. Price stability became dependent on continuous intervention. Markets adapted to support. Cheap money reshaped housing markets as well. Mortgage rates declined. Demand increased, prices accelerated, rising home values generated confidence. Confidence encouraged more borrowing. Debt supported consumption. Consumption supported GDP. The system became self-reinforcing, but leverage was the engine. Technology flourished in this environment. Startups accessed capital easily. Unprofitable firms expanded aggressively. Valuations were justified by distant future cash flows. When discount rates are low, future promises appear more valuable. Innovation accelerated, speculation did too. Growth and risk became inseparable. Governments benefited as well. Lower borrowing costs reduced fiscal pressure. Debt levels increased without immediate stress. Deficits appeared manageable. Policy flexibility expanded. Markets assumed central banks would intervene during downturns. That expectation created stability, but it also created dependence. Over time, fragility accumulated. Financial valuations rose faster than incomes. Debt expanded faster than productivity. Stability was maintained through continuous liquidity. When inflation returned and interest rates began rising, the structure faced pressure. Cheap money had supported everything. Its withdrawal exposed vulnerability. The modern economy is not accidental. It is the outcome of prolonged stimulus, low interest rates, and abundant liquidity. Cheap money prevented collapse. It enabled recovery, but it also reshaped incentives, valuations, and perceptions of risk. The real question is no longer whether cheap money built this system. The question is, can it survive without it?